Hi everyone. So today I was going across this topic about rolling down the yield curve, and it is majorly related with our fixed income securities. And I guess this is a particular topic which we really don't give much of the importance, but it actually provides a lot of information about how we price and how we, trade in the fixed income market. So let's just start by simple things, like for example, what an analyst or investor generally do when investing in fixed income security. They generally do is what maturity matching strategy, which not generally means nothing but they have the same horizon, the investment and the investor's horizon of investing in a security is same. For example, investor wants to invest in a security for 5 years. He has investment horizon of 5 years, and same as he invest in a security which has a maturity of 5 years. So he doesn't, so if the yield curve remains same, it doesn't change, so he will get the same, the coupon plus में this when it retires, he will get the par value of, example, it was 100 par bond, then it will get 100 in return. And if it was like par bond, I would say, then it will only get the coupon value and the par value which he already provided in the first place. So I would say this is what a simple investor would do, like a maturity matching strategy. But we say the yield curve doesn't go the same way. For example, if you assume that yield curve will remain same for entire 5 years, it will not move, so it's a wrong assumptions, because we generally have this assumption, or in real world it actually is like the yield curve is generally upward sloping, which doesn't mean that you cannot earn. It generally means that if we apply a little more information, then we can earn superior returns than this maturity matching strategy, right? Upward sloping yield curve means that with increasing maturity, the yield curve, or we can say the rate on the yields, increases, right? That is what we call as upward sloping yield curve. So when we have that kind of a scenario with us, what we do is we apply this strategy of rolling down the yield curve, which generally means that the investment horizon of investor is not equal to the investment horizon of the investment. And generally he would do is he has a smaller horizon than the investor's actual maturity horizon, than the investment's actual maturity, right? For example, he purchases a security, I would say a bond with 30 years in maturity. For example, he purchases a bond with 30-year maturity, right? But his investment horizon जो होगा ना उसका, that investor's investment horizon is actually 5 years. So if the yield curve is upward sloping, if yield curve is upward sloping, then what would happen is he will sell before the actual maturity, and he will earn more than, he will earn, capital returns in addition to his coupon. If the yield curve is upward sloping, then he will earn capital returns in addition to the coupon. I have this table that I have made, so to make it very clear here is that, for example, if we have maturities of 5, 10, 15, 20, 25, 30, and we have this yield which is like 3.54, which is, you should see that it's upward sloping, right? When increasing in maturity, the yield is also increasing, and the price is similarly decreasing, because they have a inverse relation. So that I'm not going into this calculation, because I know very well that all you can do it. But what I'm trying to say is, if an investor purchases a 30-year bond at a price of 63.67, right, and after 5 years what he will do is he will sell the bond, right? If he will sell after 5 years, he will sell at 71.81, right? If he sell at 5 years, he will sell at 71.81, because then after 5 years the bond will have 25 years of maturity with a yield of 5%. Now here one assumption that we have to consider is the yield curve does not change, then only it happens, like, because we have like bought it when it was 5.5% and the price was 63.67, and we sold it at 5 because we are going down the yield curve. Because if I would say this is the yield curve, this is maturity, so actually it is going like this, upward sloping, and we are going down the yield curve. Like it was 30 years and we are selling it at 25%, so it's actually what we are doing is we are going down the yield curve, right? Then we will sell at 71.81%, and we have a capital gain plus in addition of this 3% of return that we have already earned in the coupon, right? So this was the whole objective of this rolling down the yield curve process, which says that investors that usually go for maturity matching doesn't go for that, because yield curve is upward sloping, and in that environment we generally do is what we roll down the yield curve and earn extra capital profit. And also we have to keep one thing in mind, that it has also a risk. Obviously there's nothing comes without risk, so risk is that what if the interest rate we are assuming are going to be the same for whole 5 years changes and it increases for all the maturities, right? For example, if it increases, if 25 years, if we have a investment horizon of 25 years, right, and we want to sell it when the bond has 25 years remaining in its maturity, and imagine the yield for 25 years maturity of a bond increases from 5% to 6%, then we are losing, if you see, right? Then the price would be less than 71.81%. Obviously it would be less than 63.67% even. So we have to keep the risk in mind that interest rates can increase, or we can say just that spot curve can increase, and in that environment we will lose, right? So this was the whole rolling down the yield curve thing, and I believe you all understood it, and thank you for watching. Thanks.